And right now, the one part that's driving even me nuts with, we're going to double the tariff to 50%. 2 hours later, no, it's only 25. Oh, it's going to be 10, but we're going to exclude 6 products, but we're not, that is pretty hard to do business.
Or we're going to delay it and then see if you meet whatever my demand is.
And so from that regard, I'm already like, come on, man, just pick your policy and run with it.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, the last screening was in Lincoln a few weeks ago. Now we're back in Omaha with the psychology of retirement. Would you remind folks what this is about?
Yeah, this is just a great documentary on what the average American's preparedness or lack thereof is, the readiness for actually retirement. And it follows 6 or 7 baby boomer couples. It's narrated by Morgan Housel, who has
you've shared a stage with him before.
Yeah, and he's got 2 New York Times bestsellers. So we actually invested as an executive producer in the movie to help get this produced, along with some other advisors from around the country, just because we thought it was an important topic. And so we've had great success showing it here. So we're kind of showing it in each city every other month, I think. And, we're getting a couple hundred people each time out to see it, and they're giving us great reviews. And again, this is no cost or obligation, just so you get educated on, what does it look like to be prepared for retirement, whether somebody's got a couple $100,000, a couple $1 million, or tens of millions of dollars. Most people have no idea all the things they have to do in retirement to manage those assets, how to pay less in taxes, understand risk management, how it changes from when you're earning income to no longer income, et cetera. So really well done. And it's at, where are we doing this, Majestic?
This one's at the Marcus Village Point Cinema.
Village Point, okay.
Marcus Village Point Cinema, March 24th. We're going to have 2 screenings, 4:30 and 6:30. It's about an hour long, the film, 4:30 and 6:30, Monday, March 24th. Marcus Village Point Cinema. Now, as David said, there's no charge, there's no obligation, but you do need to register by calling 402-369-7777, or you can go online, retiresmartnow.com. We've got a attend an event button. You can click there. We just need to know if you're coming, and we'd love to see you there. One more time, that's Monday, March 24th, 4:30 or 6:30. That's PM, not AM, not like David Brooks. Most of us are not up and functioning at 4:30 AM. So join us in the afternoon at 4:30 or in the early evening, 6:30.
My attention span is much more likely to get through an hour video at 4:30 AM than it is PM. But yeah, you're right. My schedule is a little different than most.
4:30 PM, 6:30 PM. Monday, March 24th, Marcus Village Point Cinema. Love to see you there. One more note, scheduling note, David. We had 50 people, David, signed up for that digital asset workshop, and then one last blast from winter that Tuesday evening into Wednesday morning when we had that storm come blasting through in the 70-mile-an-hour winds. That knocked us into next month. So the digital asset workshop has been rescheduled for Tuesday, April 9th. And that is at 6:30 p.m. That's right here in the Midwest Learning Center at Retire Smart. Digital Asset Workshop, Tuesday, April 9th. I think most of you, we got rescheduled for that. But if you didn't get rescheduled, or if you'd like to join us, if you weren't on the list before, Digital Asset Workshop, Thursday, April 9th, 6:30 p.m., right here in the Midwest Learning Center at Retire Smart. All right, David, let's get into the news. Well, the markets, here's a CNBC headline. Dow tumbles nearly 900 points. NASDAQ suffers worst day since 2022 as recession fears erupt. Even one of my kids, David, sent me a TikTok of sort of the Chicken Little sky is falling. Trump's going to crash the markets and create a recession. Sort it out for us, David.
Well, I mean, the markets have been overvalued. We've been talking about this for a long time. So you're just using the tariffs as the excuse. The markets are always looking for an excuse to actually get things priced correctly. So we've had a drawdown. We've now hit over 10% and almost 20% on the NASDAQ on the a little bit higher flyer stuff. But this is normal, right? Corrections are normal, and we've gone a while since we've had corrections. And since that article, the 900-point down day, we had a 700 down day. We've had some pretty volatile swings as well. And so we actually sent a video out earlier this week to our clients, just kind of letting them know, hey, look, this is normal. This is what happens. This is how we're protecting you. This is the proactive part of our portfolios. And we just think people need to just calm down. if the white noise out there is spooking you, then you're probably not invested correctly, or you probably don't own the right stuff. And like I said, if you're losing sleep, you definitely don't own the right stuff. And so are you working with somebody who helps you understand how to allocate your assets in an appropriate manner? And the problem we find is with the do-it-yourself crowd is often they will pick the high flyers and then run them and then never let go. And so when they come back to earth, it's a little bit humbling for them, and they get into this mental state of they can't make a decision, and no decision is a decision, and sometimes that costs people significant sums of money. So anyway, just be prepared, have a plan, and that's why we recommend working with a professional.
Well, the Treasury Secretary, Scott Bessent, told CNBC there could be what he called a detox period for the economy. And President Trump himself is quoted in this story, "What I have to do is build a strong country. You can't really watch the stock market," which I think is similar to what you just said.
Yeah, and so what they're trying to do is and they've put other comments out there, and I'm paraphrasing, it won't really be our economy for 6 to 12 months. In other words, they're trying to get some excuses out of the way so they can't own the drawdown that's going to happen in the markets. And again, the market could, and we're not saying it will, but it could go twice as far down as we are now. It could easily go another 10 or 15%. And we'd still just be fairly valued by most valuation metrics. So again, we're watching some key levels. Now we had some data come out this week. CPI, Consumer Price Index, came out on Wednesday morning, and that was lower than expected. But it's exactly where I told you it would be here. And we talked about this last month, how it was hotter than expected last month, and this month you'd see that retracement. And we think you're going even lower next month. And that's not what the Wall Street or the talking heads are talking about. And I'm like, I just wonder, do you guys not know how to read data? The formula is on the website, how they calculate it, and yet I have all the same data at my fingertips as they do. So why do these talking heads miss so badly? In fact, you had Steve Leisman on CNBC, one of their normal commentators, called Trump crazy yesterday or Tuesday of this week. It was, literally, I might get fired for this. I'm crazy. And yet he completely thought inflation would be at 3.1 to 3.2 this time. So I'm like, he's either a terribly trained economist or he has an agenda. And imagine that, somebody on TV with an agenda. But anyway, the point being, don't let the white noise freak you out. I just talked about it. You've got to have a plan and how to understand how to take advantage of these opportunities, because you can rebalance your portfolio when you get a drawdown, and you can also take advantage by, in other words, if the market gets down 15 or 20%, we will start aggressively accelerating Roth conversions for some clients, things that we do, because we're able to pay even less tax than we would have doing it in the normal course of things. So there is opportunity in every crisis.
Well, speaking of economic indicators, you mentioned CPI at 2.8%. Let's keep riding CNBC here for another headline. U.S. payroll growth totals 151,000 in February, less than expected. Now, we had a precursor last week, and you even noted then, and even of that somewhat anemic number, about half is government jobs, rather than all private sector.
And that's still hiring from the old administration. A lot of they kept hiring and hiring and hiring. And so now you're seeing that go the other way. And the jobs number you get next month will not be pretty. We had the largest job cuts all the way back to 2009 in a single month in February in the private sector, let alone all the job cuts from the federal government. Now, all those federal government job cuts, Chip, will not show up in every report. Some of them will not show up till October's job number.
Why?
Because these people are being paid severance, most of them
through
they're
still
September.
On the payroll.
So they're on the payroll through the fiscal year.
So it's still a line item
right?
in the budget.
So
and the
we may not
expenses.
see the full effect of the unemployment numbers well into the late fall.
All right. Hey, you referenced tariffs before, because Trump's critics are saying, he's going to crash the economy with tariffs and a trade war and so forth. Now, there was one voice that emerged in the last week that is happy to hear talk of tariffs. A Fox Business headline, UAW leader touts Trump's Canada-Mexico tariffs as effort to stop the bleeding of U.S. jobs. Now, UAW endorsed Biden and then Harris in the recent presidential campaign, but now the United Auto Workers are saying, we actually like this tariff talk.
Well, yeah, because it would make it more beneficial to manufacture the said vehicle here in the U.S. Now, you need to understand, is the big three, Ford and GM in particular, they have massive assembly plants just across the river there from Detroit, right, in Canada. And several of these vehicles have partial assemblies of the chassis in one country and move across the border and get other parts and components added to it and then come back. And I don't remember which one. It was one of the SUVs, 13 trips across the border before completion.
That doesn't sound very efficient.
That's what I'm thinking. I'm like, how is this efficient? But it was the labor costs and the input costs and the tariffs. So what Trump is trying to do is, hey, look, move those jobs here. That'd be an American job, which is his job, right? He's to answer to the American citizenry. So move those jobs here and keep them here. And so the idea of tariffs is to make it more advantageous for a manufacturer, so if somebody's creating a product, to decide to create or invest that product here. Now, the reality is there is cost to do this. There is time. You can't just build a steel foundry or a plant to manufacture light bulbs or car parts or whatever it is overnight. So what the business community, and Trump had a business roundtable this week, and we don't have the outcome of that as of this recording, but what the business community wants, I've always talked about, is we just want certainty when it comes to tax policy, to regulation, to tariffs. And right now, the one part that's driving even me nuts with, we're going to double the tariff to 50%. 2 hours later, no, it's only 25. Oh, it's going to be 10, but we're going to exclude 6 products, but we're not, that is pretty hard to do business.
Or we're going to delay it and then see if you meet whatever my demand is.
And so from that regard, I'm already like, come on, man, just pick your policy and run with it. Now, tariffs are not necessarily a bad thing. Again, it's how we funded our government. 75% of our funding came from 1870 to 1912 from tariffs. And people need to learn history and understand what the job is. And again, we need to have a whole nother discussion on what is the job of the federal government, because obviously a lot of people think it's supposed to do a lot of things. It's not.
Up next, are you facing tough decisions about long-term care for yourself or a loved one? You're going to want to hear this next segment. Michael Luna of Senior Asset Solutions joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. How do you pay for long-term care without wiping out your assets? It's one of the most pressing issues facing senior citizens and the people who care for them. Joining us today is someone who can offer you some smart spend-down solutions. David, please welcome our special guest, President of Senior Asset Solutions, Michael Luna.
Hey, Chip, thank you so much. Yeah, back in the studio again. It's been a little while. It is none other than Michael Luna. Michael and I have been partners in various enterprises, been friends for a long time, and you are now running what's called Smart Spend Down Solutions. Excuse me, that's the class we're going to run, Smart Spend Down Solutions. But you're running a company called Senior Asset Solutions. There's no affiliation to Retire Smart. This is your company, but you've helped numerous of our clients help their parents primarily from spending down unnecessarily on things like nursing home care or long-term care delivered even in the home, et cetera. So we have the class coming up. So let's just put that out real quick. When is this class coming up?
It's next Saturday, March 22nd at 10 a.m. here at the Midwest Learning Center. And it is one class. In the past, we've had 2. But now we're just doing 1.
Yeah, so this will be one opportunity. It's about an hour-long class. You guys put on at 10 a.m. Saturday, March 22nd at the Midwest Learning Center. You can go to retiresmartnow.com and find the events tab and register, or you can call Senior Asset Solutions or our office directly. And Senior Asset Solutions, what's the number?
531-201-4494.
Say that one more time.
531-201-4494.
Very good. So, all right. So let's just get into, we haven't seen you in a little while. Yeah. So welcome back into the studio.
You. I appreciate it.
Good to see you. You're looking like you've lost a little weight to start the new year off. So you're eating healthier?
I don't know about healthier, maybe less.
All right. Well, either way, you get the result you want. That's what matters, right?
Yes.
So let's talk about how you guys are able to help clients. And because clients, I literally just spoke with someone this week who had no idea that this type of planning is even available.
Yeah. I had a conversation with an advisor at Illinois yesterday, who I met through you actually, but same response. What we try to do is really streamline the spend down process. So Medicaid in every state runs a little differently, and they have different rules. So you have to be knowledgeable about the rules in each state. And as long as you are, like I tell people, we know the playbook and we just play by the rules. And we create strategies. We work with, we take a team approach. So we don't just do things on our own. We involve an elder law attorney. It can be the client's attorney. It can be one that we provide. CPAs, accountants too, if we need to. There's some taxable accounts, retirement accounts that may come into play. But really, we just try to create a strategy that takes the burden off the family that's going through this to help them qualify for state benefits much sooner than if they just continued on the same path they are and spending and paying that check to the nursing home or for those in-home care services.
So I recently met with a client exactly that. They were telling me that their parent is 92 years old in a home spending $10,000 to $11,000 a month. They have about $380,000 left of the parents' assets that are paying for this, and then of course they're getting Social Security. I think the parents collecting just under $3,000 a month. So basically, they're having to eat up about $7,000 or $8,000 of these assets. And I explained to them, well, have you ever heard of Medicaid planning or Medicaid trust or even Medicaid compliant annuities and all these different tools that you guys have? And they'd never heard of any of it. And so they were in for a totally different reason. And then we just got into this conversation in our discovery process. So talk a little about a case like that where people, and again, you don't know what you don't know. I say it all the time. The rules and the laws changed significantly. Now it's 20 years ago, right? 2005 set in motion the opportunity to do this type of planning. Yet still here we are 2 decades later, and it's not widely known by financial advisors, by CPAs, by most people in the insurance business. They just don't even know this exists.
Yeah, it's really, that's when I discovered this about a handful of years ago, I was amazed at what was actually available to the public and what the government allows you to do. But I was also amazed at the fact that nobody knew about it. It was like the biggest secret ever. So, for instance, that client, if there are strategies, whether they're married or they're single, that we can utilize to protect basically anywhere from half the assets all the way to about 100% of those assets and get them qualified for benefits without penalizing them and causing maybe a look back period for Medicaid to say, hey, you can't.
So most people at least are aware there's a look back period, and typically we talk about the standard 5-year look back period. Each state, as you mentioned, is different, and each state is slightly different on what you can exempt, right? And it's different if you're single versus married. Some states are down at the bare minimum. You can only exempt $2,000 for a single person. Other states, the number gets higher. And on top of that, a married couple, typically, you can almost guarantee about $160,000 here in Nebraska, something like that can be set aside.
It increases every year for married couples, for the spouse that's still living at home. So it just jumped up to about $157,000. This year, that's the new figure. But the individual that's in the facility, that hasn't changed. So here in Nebraska, it's $4,000. And that $4,000 is made up of anything that has fair market value. So
IRAs, 401ks, Roths, real estate, boats, farmland, boats, cars, ATVs.
You name it.
And so they'll let you keep, I think, one vehicle and your primary residence up to a certain amount.
If you're married, you get to keep one house, one vehicle, and $157 or so dollars. Up to, though, there's rules. So if you don't, have a certain amount of assets, you may not even get that much because each state runs things a little different, like we mentioned. But Nebraska is a minimum maximum state, so they say, hey, you're going to get a minimum of about $33,000 up to $157,000. But they always divide the assets in half right at the front end to see, okay, here's how much you can keep.
So I think one of the things that's interesting is like I explain to clients. Because we referred you numerous clients, right, over the last couple of years. And when we explained to them, they're like, well, why didn't other people do this? I was like, well, people in my side of the industry, we don't get paid anything to do it, right? So explaining to someone, it's not that they don't want to do it, but people that work in an industry are going to go do what gets them paid, right? It gets their company paid. And because the solutions that are provided, you're able to charge a small nominal consulting fee to many of these families, walk them through, and then they also have to understand how to get through all the red tape of the Medicaid eligibility application itself, right? And that alone can be pretty daunting, as I understand.
It is, and we've put in a process that really streamlines this. After years of going through the hurdles of the Medicaid process and working with the state, But we do charge a fee for the services that we provide. But
And I don't think anybody has a problem with that. In fact, the clients we've talked to, oh my gosh, I'm so happy because literally it's sometimes 20 to 30 to 1 return on that fee or even higher in some cases,
well,
right?
And there's, really primarily elder law attorneys have been doing this planning and utilizing the annuities primarily. And some of them charge outrageous amounts of rates and fees, even a percentage of the entire estate value or what they protect. And we just charge a flat fee, right? We work with attorneys too, and it's like you said, it's consumable, it's palatable for that end consumer. Even if we're working with an attorney, even if there's legal aspects and work that needs to be done, the overall cost is still worthwhile and worth it to them because of what they're protecting.
And you're utilizing sometimes, not in all cases, but like what we call a Medicaid compliant annuity.
Yes.
And the majority of these annuities people to understand is they don't build in a commission or a revenue for the agent that places them. So again, why there's no incentive for people to go out and learn how to do this. So again, that's why you have to charge for your time,
You're
basically
exactly
charge a flat
right.
fee, et cetera. So it's not a bad word. These things are fantastic ways to guarantee payments to the family, to protect assets. And again, all this changed in 2005. What I think is awesome about the class that you do is you split this class typically with like Colin Kastrick, who we have on this show quite often, who does elder law, et cetera, and estate planning. Yep. And so the two of you really go through how the rules changed, what you need to be doing. And so who's appropriate to come to this class?
Anybody, individuals that are maybe trying to get ahead of this, right, that are maybe closer to that period in their life where they may be entering the nursing home, but also the children of those individuals that are watching their parents go through this, or they know that, hey, mom or dad is going to have to, they're going to need services very soon, whether that's in a facility or at home. So a wide range of individuals.
So I will tell you, the class is March 22nd. If this is you, you need to get on the phone, 531-201.
4494.
Thank you. I couldn't remember the number there. Or you can go to retiresmartnow.com, click on the events page. It's March 22nd at 10 a.m. And this could you guys can do real quick. You can do crisis planning. Somebody's already in a home, you're paying the money, or pre-planning. Somebody's going to be going in the home in the near future, whether it's you or your loved one or a parent. Do not miss this class. Michael, we're out of time, brother. Thanks for stopping by.
Thank you so much for having me back, man.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David, and we are still cycling through questions from the recent State of the Market address. This one is about tariffs versus inflation. Do you believe there is a difference between one-time price increases, such as a tariff, and systemic inflation caused by fiscal policies?
There's a major difference. So tariffs do create a short-term inflationary rise in prices. But in a free market economy, it should level out. In other words, if you're buying a product for, say, $10,000 in the U.S. and China makes this product for $9,000, it's available from a Chinese importer. So you're buying it cheaper. If we put a tariff, let's just say 12% or so, it'll equal that up to $10,000. Now the product costs the same. So there was an inflationary price increase to the purchaser of this product. However, now the competition is leveled out. So the American manufacturer now is on a level playing field, may increase his volume to get market share and then increase profitability and be able to actually lower his price over the long time. Right. And so it makes it more competitive and over time. Not only that, there's shipping costs not involved, et cetera. And the Chinese maker who's got to pay these tariffs is either willing to back away from the market and loses market share or increases the discount even more, which then the American company has to do as well. And a free market will drive those prices down over time. Now, it's just like everything else. We talk about the Laffer curve a lot here in the last 6 months or so. There's a point of diminishing returns. Tariffs can absolutely help a economy still grow and still add revenue to the government that needs the revenue obviously desperately. But when you go too far, you end up creating less of those products getting sold to the consumer. They simply can't afford them. However, so how how about inflation from fiscal policies? Well, fiscal policies don't necessarily create inflation either. Inflation is created by monetary policy.
Got to expand the money supply.
It's
That's
simply
what
the money
causes
supply. If there's
inflation.
more money chasing the same amount of goods and services, you're going to have inflation. When less money is available, you'll have deflation or disinflation. So, and we just saw that. The money supply really got sucked out of the system over the last year, and we've now just seen those numbers come through in the CPI reported earlier in the show.
Might you also, in a tariff scenario, you might get other domestic competitors who decide, oh, I'm going to get in the market. I'm going to get in the game
and the free
now.
market comes to exactly. So now
That might be another dynamic that would help bring prices down.
And
for
that's
the
exactly
consumer
right. Competition
in the long
breeds lower prices,
Yeah.
and we've seen that.
Okay.
And the less the government's involved in an industry, the faster those prices go down. The more the government's involved, and I put that chart up, I don't know, it's probably 6 or 7 shows ago, showing you healthcare, college education, housing, all the things the government highly gets its fingers
Yes.
into. The inflation on those things has skyrocketed. But electronics, computers, things that they stay out of, the prices drastically dropped over time. Not cost more, not cost the same, but significantly less.
David, here's a question about debt reduction. Why did you not? This really was addressed more to Jeff Bush than you, but we'll throw it your way. Why did you not acknowledge increased national economic growth as a third method of debt reduction? So Jeff Bush, at our State of the Market address, he did talk a lot about tax increases and spending decreases, but I think one of his points also was those two alone still aren't going to get us where we want to go. What about growth?
Well,
as
I think
a matter
as
a means of debt reduction.
I fully believe he did cover this, and that's why I didn't cover it. So I thought the question was geared at me, but Jeff did cover it. If you go back and remember his presentation, he talked about static scoring on the tax cuts and what they do versus dynamic scoring. And so that he actually went over that. He had a full slide on that very thing. The dynamic scoring is talking about the anticipated growth that would come from the deregulation and lower tax rates on companies that would increase the actual revenue. And we've got data that prove that actually works, that it worked during Clinton's years, it worked during Reagan's years, and it worked during Trump's first presidency. So we have the data on that, and Jeff Bush actually did cover that. Now, I know that was a lot of information between Jeff and myself during that State of the Market, so it might have been missed, but that was absolutely covered in the event.
I don't know that he used the term, but isn't that also the idea of supply-side economics, that actually with lower tax rates, you will get more revenue?
Absolutely.
Because your economy will be humming along and growing.
All day, every day. I mean,
Okay.
if the state of Nebraska were to incentivize business growth by saying, hey, you know what? If you build a new building and we won't raise your taxes on that building for 15 years, that's called TIF, right? That's happening right now in Omaha. Then we get economic growth that actually pays for those tax incentives. And so, yes, there are ways to incentivize growth, and you get more revenue collecting less taxes.
Got nervous there. I thought you were going to stray into the streetcar again, but let's keep moving.
We do have a Merrill race coming up that we haven't talked about. But anyway.
Boy. Back to our State of the Market address questions. Cost basis calculation, David. The question is, can you explain cost basis points and how they work?
So cost basis and basis points are two different things. So I want to make sure I understand the question. But cost basis is when you pay for something, you buy it. When you buy an asset, a house, a stock, whatever, you let's say you pay $100 for a stock and it goes up in value and is now worth $200. Your cost basis is $100. And if you sell it for $200, you're going to have a gain that you have to pay taxes on, the difference between your cost basis and your sale price. And that's the same whether it's a piece of real estate, a stock, a bond, it doesn't matter. Now, the tax code changes how you pay or what you pay for that, depending on if that's a long-term gain or a short-term gain. To incentivize investment in our community, in our markets, in real estate, everything, we give you a preferred tax rate in most cases to own these assets longer term. So a long-term, in this example, is 1 year and 1 day. You would qualify for what's called long-term capital gains rates. And for most Americans, that's either 0 or 15%. Again, most people don't even know 0 is even a rate. And then if you go over a certain threshold, you'll hit the top bracket, which is 20%. Where if it's a short-term gain, if you bought an asset, stock, bond, real estate, doesn't matter, and you sold it within 12 months, that's going to be taxed at ordinary income rates, which for most people is going to be higher. Now, I want to answer the other question real quick. Basis points, because I want to make sure I understood the question. Basis points are basically if you have 1%, that's 100 basis points, right? So if you hear us talking about, hey, the Treasury moved 20 basis points, it moved up 0.20% of the rate. And so basis points are for traders, et cetera. So just take 1%, each 100th of that is a basis point, just like a dollar has 100 pennies.
Let's squeeze in one more, David. This is about...
Or 100 cents. No, pennies or pence, right? We had that discussion recently
right.
from a listener.
Investment strategy. This question is about investment strategy. What are your thoughts on a portfolio of dividend-paying investments to stay ahead of inflation?
So we do run some dividend-paying investment portfolios, and those are typically for those that want income. We often see people come in with portfolios paying nice dividends, but it's taxable income that the client or prospective client is receiving, and they don't need. And I'm trying to explain to them, you're paying tax on this income. So understanding during inflationary periods, growth stocks outperform dividend-paying stocks. So in other words, dividend-paying stocks do well in recessionary periods. They help weather the storm. They're a little more blue chip, if you will, value stocks, and they're heavier dividend payers. But during growth markets, if you're looking for growth, that's typically not the best place to actually achieve growth. And so you need to understand how to design your portfolio for different periods of time. And in inflationary periods, growth stocks do better.
So no to battle inflation, but if you were going to rewrite this question, maybe dividend-paying investments to deal with a recessionary period.
Yeah, absolutely. Yeah, when we're in economic
Okay.
lulls, dividends are paying stocks sometimes will outperform growth stocks, and that's certainly been the case over the last 6 weeks or 2 months of the year to start the year.
Up next, is Bond villain Auric Goldfinger hoarding the world gold supply with evil intent? We'll explore that next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, I mentioned Goldfinger before because you sent the team a chart on gold imports, and there's this amazing, almost cartoonish spike, unbelievable spike upwards. Our YouTube viewers can see it. What's going on here, David?
Well,
This is gold imports we're looking at.
So there's a line waiting at the London's gold exchange to take physical delivery, and they basically have almost run out of telling people it's 2 months to get delivery. So people have been challenging, and again, there's no evidence yet of any of this, but where is the gold? Is there enough physical gold, we talked about that in recent weeks, to back up all the gold that people think they own via certain investment vehicles, physical gold ETFs and gold funds?
There was the high finance guy who told his alma mater, the University of Texas, get some physical
Kyle
gold
Bass, yeah.
on campus and make
And
sure
they
you
did.
got it because it's getting a little sketchy out there in the gold market.
So there are all kinds of rumors and conspiracy theories that there's no gold in Fort Knox, right? And again, we still don't know. And that was one of the things that Trump had been tweeting, Elon Musk had been tweeting, even Treasury Secretary Bessert had sent out. And so, so all this gold's been imported to the U.S. Where'd it go? And just, so most of the
maybe
gold
Goldfinger did strike.
Well,
maybe he
so-
succeeded in
So
that
if
operation
you
on
remember
Fort
the
Knox.
Die Hard series of movies, the third installment was in New York City.
I didn't see that one.
Oh, it's probably one of the better ones, to be honest
Okay.
with you. But basically, it was Hans Gruber's younger brother, played by Jeremy
really?
Irons, is the villain in this
Oh,
one. He does a really good
great.
job. But really,
Is this also a Christmas movie?
No, this one
Okay.
they're acting
All
more
right.
like terrorists, and they put these bombs in all these public schools and
Oh, wow.
scare the
Okay.
bejesus out of everybody. But really, it's all distraction. They're trying to steal the Federal Gold Reserve about 8 stories below in New York City,
Oh.
and it's a pretty interesting movie in there. So now the question is, was the gold really there? Right? Is the gold there? Is it in Fort Knox? Where's the gold? Why is all this gold moving around? And we've seen foreign nations buying gold over the last 18 months at an alarming rate. And here's the interesting thing: retail investors have not really been gobbling it up. And some people thought it because the price had moved drastically, and like the price is pretty close to $3,000 an ounce now. If it breaks that, you can see 3,300 almost overnight. It'll just break through. But yeah, it's just interesting to see what's going on here. Why is all this gold moving? Because you got to remember, all these cargo ships have to tell us what's on there, and gold has been on almost every commercial flight coming into the U.S. as well. So inside the luggage container, they've been sticking literally bars of gold in there on commercial flights, bringing them back to the U.S. So whose gold is it? I don't know at this point.
Well, what about all the commercials out there, encouraging people, put it all in a gold IRA and so forth? I guess you've warned against those, but at least I thought gold itself was a solid investment.
Well, here's the problem. The gold IRA, you can't take physical control of that, right?
Okay.
So I have no problem if you want to go buy gold, look at the spot price, go pay. You're going to pay a small premium over that. The dealer who's selling you the gold certainly has to have some kind of margin to stay in business. But if you want to buy gold and then store it yourself in a safe, bury it in your backyard, whatever the case may be, I own gold, I own silver, physical, right? They're mine. But I do not recommend people buy these gold IRAs because these are just scams. These are unlicensed, non-securities professionals selling you a commodity, and they're selling you at a fat premium, typically 15 to 20% over spot price, right? So I heard one on the way in this morning, $15,000 in free gold. Gee, how much gold do you think you have to buy for someone to give you $15,000 of gold and then maintain their profit margin? You're getting taken to the cleaners. On top of that, if it's one of these supposed gold IRAs, they are going to store it for you, secure storage facility, and pay you for the guards. You're going to pay for that, for the storage, for the safe it's in, and for the accounting of it, because they have to value it at the end of every year. For your IRA has to have a declared value for the IRS. You can't physically hold it. And then when you go to sell it, and you're like, I want to liquidate it. They tell you they have to melt it down to get you cash. They're not melting down any of the gold. That's nonsense, right? But we had one client who's no longer with us. He passed away recently, but unfortunately was taken like this a couple years ago. Gold went up $600 in the 9 months he owned the gold.
You mentioned this before.
And he lost over 40% in the value of what he paid for it versus what he liquidated it for. Please, please take caution from these people that are preying on people's fears and scares right now.
Well, speaking of sketchy financial practice, David, you sent the team a couple of charts regarding what we've now learned about credit cards issued to federal government employees. Well, your description was this was beyond insane. Why, David?
So a couple 100,000, 230,000 credit cards on the board right here, right? But these departments don't have that many employees. Some of these, so there's 2 and 3 credit cards sometimes for each employee that were able to just purchase and expense things on the federal government with no hindsight. The accountability was terrible. So they went to shut these off, and somehow I guess a judge said you can't turn these off until you get congressional approval or something or whatever. So they were smart. They went and took the limit down to $1 on each of the credit cards, the current administration, to get spending under. And one of our employees who was a former federal worker said, yeah, absolutely. I had 2 different credit cards, and they were telling me just expense what you want.
Last week, Tim Herrick.
Yeah, and he was just talking about, just spend what you need to on there and all kinds of expenses. It was crazy. So again, this is, I have a couple of employees that have credit cards here, but I'm very careful who I hand them to because I don't want someone getting frivolous with expenses. And so this is just, an outlier here, but this is just one of these things that why Doge is so popular. Over 74% of Americans support us becoming transparent with what we're spending our money on. It's absolutely insane where this money's going.
Boy, the government mindset. What? You want me to send an email detailing what I accomplished today? What? You want me to account for my expenses on the credit card?
Well, and this week we saw, I guess about half of the Department of Education people are getting let go, and again, that's probably making you smile because that's the lobby you think you've always had to fight against. Let's send education back to the states where it belongs, right?
Yeah. And then we can go to work on it there too. All right. Let's get this in, David, because you thought this was important enough to bring to the team. Largest volume day on Invesco QQQ ETF, Exchange Traded Fund, in 2 years. Largest volume days have marked bottoms. You're talking about in the markets in the past. And we've got a chart for the YouTube viewers to look at. But first of all, David, I went to the Invesco website because, okay, QQQ, that got my attention. I can't figure out, what does QQQ stand for?
So that's just an ETF. That's just the ticker symbol for the NASDAQ that ends in a Q. That was one it's been one of the longest running ETFs out there, most successful. It basically tracks or invests in the top 100 stocks listed on the NASDAQ. So it's going to be tech heavy, as you can imagine. We actually, full disclosure, we own this in several of our portfolios for our clients, a very low cost vehicle. That is a bit of a higher flyer. It'll get you the gains when the market's doing well and the tech sector's doing well, et cetera. But as you can see from the chart on the screen, if you can't, it's pulled back over 15%, almost into a bear market territory, or 20%. And so we saw a capitulation earlier this week with that massive spike in volume. And again, doesn't mean the bottom's in, But what we see, Chip, is market bottoms, at least short term, usually are marked by some form of capitulation. So people, I've had enough, I got to sell it and I got to get out. And they just sell at whatever price versus having, I always tell people, look, don't sell on red days, sell on green days, and vice versa. You should be buying on red days, et cetera. But you want to, just don't make panic moves, because this is showing you the average retail investor did just that, peaked. And then what we have? We had CPI come out in good, better than expected, and the NASDAQ jumped about 1.5–2% in 5 minutes. And so everybody that sold out here is like, oh, maybe that was the wrong thing to do. So again, don't make hasty decisions when it comes to your risk management. Have a plan and execute on that plan. Is there a rhyme or reason to why you're buying or selling whatever it is you're buying or selling? And if you don't know how to do that, that's why you should seek the counsel of an independent fiduciary-based advisor, at least in my opinion. Doesn't have to be us, but you should be working with somebody who can help you understand how to allocate your assets.
David, we're just about to the end of the line here. For folks who weren't with us at the beginning of the show, would you just give us about 30 seconds again on the movie that we're once again screening locally, The Psychology of Retirement?
Yeah, so this is a great documentary that just basically explains what it's like or what people are looking at going into retirement and how unprepared the majority of people are, even people that have acquired a decent amount of assets in retirement. Really well done. Morgan Housel, New York Times bestseller. And if you've never read his book, The Psychology of Money, highly recommend that as a great gift to recent college grads, et cetera, because it just helps people understand how to create wealth and how to invest money. Now, I also want to take a moment. We had a gentleman, I guess, send in asking. I had referenced, I had to look it up. You told me just before we went on the air today, Stanley Druckenmiller shorted bonds, and we talked about that the last week of October. So this is going all the way back about a week, 2 weeks before the election. He said he was shorting U.S. bonds, and I guess one of our listeners had emailed in, hey, how did that work out? Well, I don't know if he still owns them or not, because I haven't read his first quarter, 13F, where he has to file and show you what he owns. But at the end of the year, he did really well. He made about a 9% gain shorting the U.S. bond market from October through January. And the bonds peaked in around the second week of January, and they would have lost money, not all of it. It's still higher today than it was then, so he'd still be up if he still owned them. But we've seen, so as interest rates went up during that time period, that's why he made money. As interest rates go up, bond prices go down. Now, since Trump got inaugurated, about the third week of January, we've seen interest rates steadily come down. And so the 20-year bond has come down over 50 basis points. The 10-year was at 4.7 when he got inaugurated. It is down in the 4.20s today. It was as low as 4.15 earlier this week. And with the CPI coming in lighter than expected, that's giving some the good news to the Federal Reserve, who wants to lower rates again later this year. And now, as we sit here today, there are 3 rate hikes priced back into the market, at least in the futures market, so telling us the Fed's going to cut 3 or maybe 4 times this year, where just 2 weeks ago that was only 1. So again, numbers change quickly. We have to pay attention. But Stanley Druckenmiller made money with his call at least the time. And again, I don't know the outcome if he sold or what have you. And those guys sometimes will front run because they are smart. So they make their positions, get everybody else to buy in, and they usually sell out and will tell you much later, oh yeah, I got out of that trade.
So things played out in a way that made his scenario work. We just need to see confirmation of it. But yeah, interesting. All right. Hey, that'll do it for this week, folks. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer, including smart spend down solutions. No charge, no obligation for our events, but you need to register. You can do that online or by calling 402-369-7777. David, bring us home.
Hey, the spring weather seems to be here for real. Enjoy it and have a blessed and prosperous week. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Michael Luna is not a client and was not compensated for his appearance. Michael Luna and Senior Asset Solutions are not affiliated with Retire Smart. However, Senior Asset Solutions does share clients with Retire Smart.